Sudden silver demand surge. Paper trading versus physical trading war. How COMEX versus Shanghai fuels it. The global silver wars simplified as silver becomes global supply chain battleground.
Hello and welcome. You're watching Explained by NewsX. I am Devika Dhawan. For decades, silver was viewed primarily as a more accessible alternative to gold. But as we stand at the end of 2025, that narrative has changed. Silver has transitioned from a decorative commodity into a high-priority strategic industrial asset. Silver prices in India currently trading at nearly rupees 2,40,000 per kilograms, reflecting an upward trend. While this follows a slight correction from yesterday's peak of 2,58,000, the long-term growth is staggering. For context, silver was priced at rupees 2,22,000 just last week and sat below rupees 90,000 exactly 1 year ago, marking a massive year-on-year increase. But this isn't just about a price tag, it is about a structural shift in how the world values money, metal, and power. Today, we're breaking down the mechanics of the two global exchanges, the battle between paper and physical silver, and the brewing geopolitical war for the world's shrinking supply. To understand why silver is suddenly worth more, you have to look at two cities, New York and Shanghai. Historically, silver prices were dictated by the COMEX in New York and the LBMA, in London. These are the Western hubs. Prices here are calculated based on futures contracts, essentially bets on what silver will be worth months from now. However, the Shanghai Gold Exchange has emerged as the Eastern powerhouse. Unlike the West, which often settles trades in cash, Shanghai is a physical-first exchanger. The calculation is simple, but the gap is widening. While the West looks at interest rates and the US dollar, the East looks at inventory. This year, we've seen a massive arbitrage or price gap. Silver in Shanghai has consistently traded at a $5 to $8 premium over New York. It means if you have a bar of silver, you will get nearly 10% more for it in China than in America. There now exist two worlds of silver, physical and paper. Physical silver is what you can touch, the coins, the 1 kilogram bars, the jewelry. This is retail silver. When you buy this, you own the asset outright. There is no counterparty risk. If the lights go out, the silver is still in your safe. Paper silver, on the other hand, is a digital promise. This includes ETFs and futures contracts. It allows you to profit from price moves without ever touching a metal bar or paying for a vault. But here's the catch. In 2025, investors are waking up to the terrifying math problem. The difference in volume between these two worlds is staggering. On the COMEX and the LBMA, the volume of paper silver traded every day is often 10 times the amount of silver that is actually mined in an entire year. Market analysts estimate that there are now over 300 paper claims for every 1 ounce of physical silver sitting in a registered vault. They want the physical metal, and there simply isn't enough to go around. Look at these numbers. On the COMEX, less than 1% of trades actually result in someone taking delivery of a silver bar. But in Shanghai, the delivery rates are significantly higher. In fact, on some Shanghai contracts, 100% of the trade must be backed by physical metal. Because China is the world's largest consumer of silver for industry, their exchange reflects the real price of a scarce commodity. This is why Shanghai is leading the price rally, while New York is struggling to keep up with the paper to physical disconnect. The silver market is in a structural deficit. We're using more than we can mine or that we've mined in the past 5 years. Silver is the most conductive metal on Earth. It is non-substitutable in solar panels, which consume nearly 200 million ounces just this year, and electric vehicles, which use double the silver of a gas car. The demand continues to grow. This creates a fundamental supply-side conundrum. Silver production is almost entirely based on price because approximately 70% of the global supply is a secondary byproduct of copper and zinc extraction. China has spent the last decade quietly draining Western silver reserves. They have recognized that silver is a critical mineral for the green energy transition. Starting the 1st of January 2026, China is implementing a new era of export controls. The rules are stringent and designed to keep silver within Chinese borders. Number 1. The licensing system. All silver exports now require a dual approval license from provincial and central authorities. Second, production thresholds. Only large-scale refiners with an annual capacity of 80 metric tons or more are eligible to apply for export permits. Number 3, financial scrutiny. Firms must maintain a minimum credit standing and a specific liquidity ratio, ensuring only state-linked giants participate in the trade. Number 4, strategic quotas. Export volumes are now capped based on national supply security, meaning if domestic demand rises, exports are automatically throttled. We are witnessing the silverization of the global economy. How will this impact geopolitics remains the big question.
Sudden silver demand surge. Paper trading versus physical trading war. How COMEX versus Shanghai fuels it. The global silver wars simplified as silver becomes global supply chain battleground.